Hello friends, welcome to learning sessions and this video is related to the now stress testing is what I told you that under the VAR we just assume the normal circumstances, we just assume the normal events, we don't consider the abnormal risks, we don't consider the risks which are beyond the day-to-day risk monitoring, right? We don't consider that under the normal VAR, but in stress testing that is to be done. We have to look into the possible changes in the market value of the portfolio which may be there due to the abnormal movements, right? Let's case there is a war or war zone, or let's say due to the COVID or anything, we want to look into the stress things that about the abnormal scenarios, right? So the process involves that we need to identify the stress posing parameters first of all, stress posing parameters which may cause beyond the normal stress, which may causing beyond the normal stress. We need to identify those market parameters. We need to look into the quantum of the stress which may be there, and we also need to determine the time frame, that over which time frame or what time frame the risk may be imposed. These are the three important things which are to be followed under the part of the stress testing, right? And it is having the four different techniques. Like we are having the techniques like simple sensitivity test, scenario analysis, maximum loss, extreme value theory, or namely it is EVT, right? So we are to cover all these four types for the stress testing purposes. Now you understand what is the purpose of the back testing and why the stress testing is used, and what is VAR, what are the different approaches related to it in just span of 30 minutes. 30 or 40 minutes so far. So if you have liked the content so far, give this video a thumbs up. Do like this video. Do share this with your friends and colleagues, right? And moreover, if you have not subscribed the channel so far, do subscribe the channel at the earliest. So if we're talking about, if I'm going to tell you in very short about the simple sensitivity test, we are going to measure the impact of a single risk factor in case of simple sensitivity. Like in case of sensitivity, we just isolate one single parameter and going to change only that particular parameter in a unit manner and keeping all the other variables constant. That the same part we are going to consider for the simple sensitivity test. For SST, I say it personally SST, right? Like Sara Sal tension like thing. It's a simple sensitivity test, right? So SST or simple sensitivity test, we just assume one single risk factor and we do assume that the other risk factors are constant, right? Let's say case we are going to change the interest rate by 1%. It could be we are increasing the interest rate or subtracting the interest rate by 1%. And we are going to change the interest further. Since let's say in the normal scenario, the interest changes are ranging from 6 to 7%. But under the normal abnormal situations, it may be like it's going 12% or even 15% or 20%. So we'll be looking into it at what the adverse impact it's going to make on our portfolio, right? But the limitation is that in case of the simple sensitivity, that it basically ignores the interaction of the different risk parameters, right? But it is very much quick, it's very much easier to perform, right? That's the case. The second one it's mentioned here is scenario analysis. Now scenario is related to that we will be making some simultaneous changes into the different risk parameters, but it will be a single scenario. Like if I assume that the interest rate is changed by 6%, demand and supply are changed by this particular percentage, or the other risk factors are changed by this particular percentage or something. Now that will be forming just one scenario. In same manner, I'll be having 100 or let's say thousands of the scenarios. Now those scenarios may be historical, like based upon the financial crisis data or something, or those may be hypothetical, where I am assuming the points or assuming the different factors to be in one particular scenario, right? And the good part is that it can be helping us so as to capture the non-linear effects. If there is any non-linear effect, we can capture that particular part, and it's way more effective than the SST. Way more effective than the SST. Now the third one, maximum loss. It's the worst possible loss ever. Like it could not be. It is very much extremely plausible condition. Like may not be even possible in real scenarios, right? It's a maximum loss. Like we think our way, na, like what maximum is going to happen, right? Maximum I'm going to lose this job, maximum going to happen like this only, or maximum loss could be like this only, right? that is maximum loss. Like if you purchased a car and let's say it's wrecked, an accident was there or something like that, right? What will be the maximum loss? You'll be saying maximum loss would be 50,000 rupees, not more than that, right? Under the normal scenarios, the loss would be 10,000, but under the worst scenario, the maximum loss could be 50,000, or let's say rupees 1 lakh over there. That's the maximum loss, right? So in this case, in case of the maximum loss, we don't consider the probability distributions. We don't consider the anything which is normal. We're just considering or focusing on the tail end risk beyond the VAR. So here is a data, here is a graphical representation, and here is we are saying normally distributed, and here is a tail part, right? So under the we are considering the components related to this particular factor. Let's say up to this particular mark, we are considering the risks in case of the VER. But in case of the maximum loss, we'll be going for these tails, the extreme tails, right? That is a maximum loss. And what about the EVT? Now, EVT is very much important and very much famous, and it's a statistical technique, right? So if a high threshold is there, then it's going to capture all the rare catastrophic losses, right? So what the limitation related to VAR is, it addresses the same, right? And it is used for stress VAR and expected shortfall estimations. So now let's cover it. So as I told you, in case of SST, we do isolate one particular parameter from the others. We keep others constant, and we're just going to change this one only. It is good one, but not going to helpful, is not going to be that much helpful because it's not practically possible. Scenario analysis related to, either you are going to pick the analysis or scenarios from the history, or it could be that you have assumed the different scenarios. The scenarios are hypothetical. It may be the case. It's going to capture the correlation and known linear effects, but it's way more, realistic than the sensitive testing. But that's the case about it. Further, it's related to the maximum loss. It's going to assess the risk by identifying the most potentially damaging combination of the different moves. Like if we say interest rate can be going like this to 12%, maximum it can be going up to this factor only, and maximum this thing can be going beyond this factor only. Now we are just interested into capturing the maximum or the least values which could be adversely affecting us, right? And the combination of the these dead weapons, right, it's going to a lot of pain to our portfolio, right? That's the maximum loss theory. And after that, it's related to the EVT, that is the extreme value theory. So it means what? That it's better to capture the risk of loss in extreme but possible circumstances. Because in case of the maximum loss, we were even covering the situations which are not practical, not possible circumstances. But in case of EVT, we are going to cover the risk in loss for the possible circumstances. And it's a statistical theory. We are going to look at the behavior of the tails, right? Like very high or very low potential values of the probability distributions we are going to look for. That's the case. And despite these only drawbacks, even if there are so many drawbacks, EVT is notably the only stress test technique that attempts to attach a probability to the stress test results, right? So it's going to attach the probability to the stress test results. That's an important point to be taken care of, right? And what makes a good stress test? It should be relevant. Very good. Definitely, it should be relevant to our situation, first of all. So if there are going to be any possible changes in the market, it should be considering the same. It should be considering the market illiquidity also. And if there any potential regime shift, like current risk parameters will hold or break down, it should be looking into those factors also. And it should be considering the interplay of the market parameters and also related to interplay of the market and the credit risk. Is that clear? Please confirm. Now after that, it's related to that how the risk managers be using the stress test. how the risk managers be using the stress test. Now, see, stress tests are going to let you know about the extreme but possible circumstances, not in the daily life, but they may happen at some time or some instance, right? So, it's a role of the risk managers that while they are preparing, while they are arranging the capital for their risk or summarizing the information related to the risks to the senior management, they should be understanding that there is a little, but there is a possibility that these risks may also be there, right? And they should be keeping their appetite ready for the same, right? So it helps us first to manage the funding risk. Now, in the worst scenario, how we are going to manage our fundings. So as to provide a check on the modeling assumptions, even if we want to set the limits for traders or determine the capital charges, we should be looking into it and all the things should be considered. Now, what are the limitations of the stress tests? Now, stress test may not be transparent or may not be straightforward, right? And definitely, we are going to assume so much values into it. It may be the case that a hypothetical cases may be there, right? So definitely, it may be biased, right? So even if you make so much choices, the risk manager is in the phase that he is to look into different things. He need to identify that what implications could be there. Is it possible? Is there any probability attached to that particular outcome or not, right? That's why EVT is very much important, because it is attaching a probability to the event, that these events may be occurring. What's the probability related to it? That's why EVT is very much important, right? So system incompatibilities may be there, like, and whatsoever the assumption that the risk manager has made, those may go in vain. Those may go in vain, right? So that's the case. Now after that, it's related to the risk monitoring and the control. Risk monitoring and the control. Now, implementation of the risk policies and the business policies, that is to be done side by side. Simultaneously, those are to be followed. It's not the case that we are going to control the risk and so that we are not taking the risk, so as to make the profits or so as to meet up with the corporate objectives. So that's not the case. We are to be implementing those both policies, risk policies as well as the business policies, simultaneously. We should be keeping our objectives higher, and we should also be setting up the limits so that whatever the risks which are involved or which may be involved, we are going to capture those risks and we are having the guidelines for the same, that how we can be managing such risks and how can be having the risk appetite for the same, right? So that is to be done. So that's related to ensuring the best RAROC, risk adjusted return on capital. So that will be helping us that how we can be capturing the best RAROC, right? So whenever I'm talking about we want to control the risk, it means that we want to keep the variations in such a manner under the given portfolio that we are having the boundaries already set, that our risk or the value at risk must not be going beyond this particular value. We should be setting the limits for the same, right? And it can be actively done. And how can it can be actively done? It can be actively done through the policy guidelines, if we set the policies for it, or let's say we are setting up the trigger limits for the same, or we are having the limits structure or the approval process, or let's say we are having the system and procedures so as to unbundle the products over there so that we can capture all the risks in the transactions associated with them. And there could be the guidelines related to product size and product mix. Product size or portfolio size is related to what? It's related that you are having the multiple assets in one bucket. Now, the complete bucket is amounting 300 crore. So that will be our portfolio size, right? And what type of loans could be there? Like what type of different assets or investments can be there? Like we are having loans related to housing loan or agriculture sector or corporate loan to the corporates or something like that, right? So the guidelines for the portfolio size and portfolio mix may also be given, right? And further, there should be a system that we can be estimating the portfolio risk under the normal, under the stress situations, right? That's the case related to it. And also there could be the limits related to monitoring and the reporting purposes and performance measurement and the resource allocation purposes. Now these are the very general guidelines. Now just think it from the management point of view. So if you're going to invest your money into something, definitely you'll be looking into it, that what could be the maximum loss, what could be the investment, let's say, let's say market is very down. Let's say you're going to invest in equity, right? And you're considering to invest rupees 1 lakh. So either way you can be selecting, like you can be going like this way, that you're going to invest into equity shares of TCS 1 lakh into equity shares of TCS only, right? Or the other strategy, it could be related that you may be thinking that the TCS share value is showcasing that there was a huge volatility in this particular year, right? And this could happen again. Now, this is actually looking into different historical data, or it could be also related to that you're going through their balance sheet or going through their financial data, and you basically looked into the thing that it may go down, the share price may go down, right? Like let's say if it is leveraged, or it is just not valued that much in the market value as such, but it's valuing more than what's actually value of it is, right? So you'll be thinking like that way, and it may the case that you will be selecting multiple shares, like you selected the shares of TCS, LIC, PNB, and different organizations, and you said we are going to invest rupees 1 lakh combinedly into this particular thing. Now you're having a portfolio. Now this thing is representing your portfolio where the diversification is there. So whenever I'm talking about the controlling and monitoring part, we are considering about the different guidelines. It could be related to the policy that you are following. It could be about the structure. It could be related to the procedures. It could be related to the your portfolio mix or portfolio size. It could be related to that you're estimating the portfolio risk, that how it can be done. It could be related to that you're going to limit the monitoring or reporting, right? And how you're going to measure your performance, how you're going to allocate your resources. Everything is covered in it, right? Is that clear? And after that, it's related to the limits and the triggers. Then it's related to the limits and the triggers. Now, limit is what actually? Limit is like, let's say there is a manager who is going to manage the fund, right? Who is going to manage the fund, and he is going to invest that particular fund into the market. Now you put a limit on him that you cannot be investing into single company more than rupees 2 lakh. You put a limit upon that. Now your maximum exposure to one particular company would be limited to rupees 2 lakh in that scenario, right? Or it could be related to stop loss limit. Stop loss limit could be there. Let's say the person invested the value, and while investing the value, you're already having the stop loss limits with you, that if the share price went down below 35%, then you will be scaring off your position. Let's say you purchase the share at rupees 600 and you set the stop loss limit at rupees 65. Now you just hypothetically you said that the prices, the market will be having a bounce, but it basically bounced back. It's bounced back. Now the share price is around, let's say, rupees 67. The moment it will be capturing price of 65, you'll be scaring off your position, means you'll be selling off your shares that you purchased at rupees 100. While doing so, you basically limited your overall loss. Let's say it went below even to rupees 50. Now you basically did what? You actually managed your losses in that value. You limited your losses in that value, right? Now the approval and the limits could be set up, like limits for the approval, limits for the taking decisions are set up, and those are set up by the designated authority. Let's say the senior management team or the ALCO committee, or even maybe approved by the board of directors, right? So sensitivity and value at risk, they are going to limit for the trading portfolios, accrual portfolios. Those are measured at daily basis. And if those are not measured on daily basis, value at risk limits are not measured on daily basis, risk taking units must be having the procedures that how they're going to manage their activity. We are talking about for the trading values, for the trading portfolios and accrual portfolios. So even so if for the trading portfolios or for the accrual portfolios, if they are not having the daily values, if the VAR or sensitivities are not going to be measured on daily basis, then in that scenario they must be having their procedures that they are going to monitoring their activity effectively, right? That's the case. And the approved management triggers could be there. I just gave you the examples related to it, what kind of triggers it could be, right? Different markets may be having the different triggers for them, like under this situation this is to be done, under this situation this particular that thing is to be done, like something like that. Further, it's related to risk monitoring. So what's of the transactions are being done, those should be re-examined, right? Those should be re-examined, those should be revalued, right? And whatsoever the rates are being used, those should be independently verified. Financial models for the revaluations may be used for the income recognition purposes. You should be looking into the different parts. Stress tests can be performed on quarterly basis, let's say, right? So that's about the risk monitoring, that how we are going to monitor our risk. So it clearly says now that on 26th of March 2024, on 26th of March 2024, your customer has presented to you their bill of USD 50,000 drawn on party in USA and request you to purchase the same So it's about the bill purchasing. So what is the process related to the bill purchasing? The process is quite simple. Let's say person A, who is our customer, is the exporter, right? And he basically exported the goods to person B, who is residing there in USA. And person E sold the goods on credit to person B, but the person B has not paid the amount yet. So we basically draw a bill of exchange on the person B. So person A is going to be the drawer of the instrument, and it is drawn on the person B, who is the debtor. So the person B is a debtor who is to repay the money, and he is the drawee on whom the bill is drawn. So person A drew the bill on person B. Okay. So bill of exchange is a unconditional order by the drawer to the drawee so as to repay the amount on demand or otherwise as per the tenor of the instrument. Okay. So the bill is to be accepted by the person B, who is the drawee, who is the debtor, who is the importer. Okay. And after the acceptance of bill, the bill will be returned to the drawer. The bill is returned to the drawer. Now, the drawer wants the liquidity. The drawer wants the liquidity. So person A went to the bank and asked the bank XYZ so as to discount it or so as to purchase it. It's just about the nomenclature. Because when we're talking about the usage bill, the term is used related to discounting the bill. The term is used related to discounting the bill. But when we're talking about the demand bill, the term is used related to purchasing the bill. So it's a different nomenclature, right? Demand bill, which will be repaid when it will be presented, and the usage bill, where is a fixed tenure which is given or credit period is given over there. Okay, so it's about it. Or let's say a future due date is given. That's a usage bill of exchange. Now in this scenario, they say it's about the purchase. It means we are dealing with the demand bill of exchange. We are dealing with the demand bill of exchange here. So the person A basically sold this bill to the XYZ, and XYZ purchased this bill, and immediately a liquidity amount will be given to person A. And on the due date, or let's say if it's the case of the demand bill, the bill will be presented to person B, but it's going to take some time because B is in some other country, is not in the same country, right? So XYZ is in the hometown of A and B is in other country, and XYZ bank through its correspondent bank will be presenting this bill to person B, and on presentation the amount will be repaid by the importer to the XYZ bank here. So that is a whole scenario. Now in this scenario, we can just be looking at that the bill won't be cleared on the same day. There will be a lag between it. There will be a lag in between. So that's why the TT rate won't be applicable. And what rate would be applicable when there is a lag? It's the bills rate which will be applicable. It's the bills rate which will be applicable. But we don't know that what court will be given. Now, once you get to know about the question, it's about the who was the owner of these USDs, 50,000 USDs. Who was the owner? Person A was the owner, who is a customer to the bank, right? And person A basically want to sell these USD to the bank in a way, right? So it's just like that person A want to sell the USD, and it's a merchant rate which is applicable because the bank is dealing with the customer. So the customer A will be able to sell these USDs at a price at which the bank is ready to buy. So what quote will be given by the bank? It's a buying quote which will be given by the bank. It's a buying quote which will be given by the bank to the customer. So it will be the bills buying rate which will be applicable. And whenever we are talking about the buying rate, bills buying rate or bill selling rate, the forward rate points would be applicable. Yes or no? Yes, those are to be applicable in this scenario. Why? Because we are going to get the value today, but the bank is going to discount that particular value after some particular time of period. So bank will be giving us the value as per the contracted value after that particular tenor. Okay. So in this scenario, the question says that the spot rate is given, and further that 1 month forward rate is given, and transit period is 20 days, and exchange margin is 0.15%, and transit period to round it off to the higher month. It is to be rounded off to the higher month. The transaction took place on 26th of March. And after 20 days, if we consider 20 days, then the date would be 15th of April. It will be 15th of April, which is basically the next month. And they say that the transit period is to be rounded off to the higher month, right? To the higher month. And that's why we have to consider 1 month forward rate here. We have to consider 1 month forward rate here. So this is a spot rate which is given to us, which is spot price is given to be 72.30/40. This is a buying forward, buying points, buying quote, and this is a selling quote. And what quote is to be considered? It is a buying quote which is to be considered. So it is 72.30. That is a buying rate, which is a buying rate that is to be considered. And further after that, the forward points are given, and the forward points are given to be 0.40, 0.50. Now the points are increasing from left to right. So it's a case that the currency would be available at premium. And whenever we say the currency is available at premium, the forward points are to be added up. So it is the buying forward points to be considered. So 0.40. These forward points, because the currency is available at premium, those are to be added up. So it is 72.70. This is 72.70. But keep in mind the exchange margin is also applicable. The exchange margin of 0.15% is also applicable. So it is plus 0.15%. That is to be added up. So 72.7 plus 0.15%. So it is 72.80905. This price would be there. This is a price according to which the bill is to be purchased. The bill will be purchased at this point, right? So that's the case. So what amount will be given to the customer? It is 72.80905 multiplied by 50,000 USDs. Multiplied by 50,000, and that is 36,40,452. This amount is to be credited to the exporter's account. Okay. So this was a clear case related to the bills buying rate. So what formula would be there related to bills buying rate? Very much easier to calculate. Spot rate plus minus either the forward points are to be added up if the currency is available at premium, or these are to be discounted if the currency is available at discount, right? And further, we are to subtract the exchange margin, because I told you the clear point. If the transaction is related to the buying transaction, then the exchange margin is always to be separated. It doesn't matter if it is a bills transaction or the TT rate transaction. If it is the buying rate, then in that scenario, the exchange margin is to be subtracted. It is to be subtracted. And what will the formula related to the TT buying rate? What will be the formula related to TT buying rate? Very much easier. It was simply the spot rate, and the forward rate points are not to be considered, and minus the exchange margin. That's it. This is a simple formula related to it. Even you don't need to cram the formulas. You just should be knowing the formulas, knowing the logic behind it. You should just be knowing the logic behind it. And after that, the question says an importer has requested something. The third one. Importer has requested you to issue a demand draft on USA for 50,000 USD. Spot rate is given, exchange margin is given. How much amount is required to be paid by the customer, by the importer? So let's say we are having a importer person A who wants to remit 50,000 USDs by way of issuing the demand draft. And he basically came to the bank XYZ, right? And XYZ bank is basically maintaining a correspondent account with the bank PQR in the other country, in USA, let's say. And here the bank is maintaining an account which is said to be the Nostro account. That is our account with you. It's a foreign currency account which is maintained by the Indian bank in the foreign country. Okay, with in foreign currency. So the bank will be doing what? The bank will be debiting their Nostro account and will be issuing a demand draft to the customer. But if you look at the very basics, if you look at the very basic of this question, person A want to remit what? Person A want to remit 50,000 USDs. 50,000 USDs are to be remitted. Only possible if the person A is having in possession 50,000 USDs, right? And person A is having the money in INR, because we want to say na, that what amount is required to be paid by the customer. So person A is having INR and person A wants to buy USDs. The person A wants to buy USD. So what rate is applicable? It's a customer who is dealing with the bank. So the merchant rate is applicable. Now you should be knowing clearly that what rate is applicable. It is a merchant rate which is applicable. Now the person A would be able to buy at a price at which the bank is ready to sell. So the bank will be giving what quote? The bank will be giving the selling quote. The bank will be giving the selling quote. Clear with it? So we are to consider the selling quote. Now, just tell me, it's a TT rate or the bills rate which will be applicable here? It will be the TT rate. Why? Although it is written here, but even if it is not given to you, you can be getting to know about it. How come? You just know that the account is to be debited. The Nostro account is to be debited and the demand draft will be issued. So the debit and credit will be done on the same day. So the demand draft will be issued on the same day. No lag in that. And if no lag is there, then the TT rate is applicable. And in TT rate, there is no rule related to the forward points. Simple as that. So the spot rate that we know, it is given to be 76.32 slash 48. This is a buying quote. This is a selling quote. And we are to consider which one? We are to consider the selling quote, because the bank is to give the selling quote, right? So we know by now that what rate is applicable. It is a TT selling rate which is applicable. TT selling rate is applicable, that we basically know now, right? Now the selling price will be picked up, so it is 76.48. The exchange margin is given 0.15%, and it's what transaction? Buying transaction or selling transaction? It's selling transaction. And whenever it's related to the selling transaction and we are given with the exchange margin, the exchange margin is to be added up. Keep in mind. So it is 0.15%. So it is to be added up. So 76.48 plus 0.15%. So it is 76.59472. 59472, and we want to tell that what amount is to be paid by the importer. So multiplied by 50,000, because 50,000 worth demand draft was to be issued. So the answer is 38 lakh 29,736. This amount is to be paid, right? I hope that you must have understood the logics. I'm pretty sure that you must have understood the logic related to this question. Clear with it? Now let me just hide the next question data from you. First of all, let me just hide the next question data for it from you so that you can be answering it. Let me just do the needful. Okay. Okay. I just have concealed the data related to what type of the rate would be applicable, and now just try to solve it. Now let's try to solve this question. Now the question says that on 26th of March 2024, importer has received an import bill for USD 50,000. He asks for the retirement of the bill. He asks for the retirement of the bill. I'll be explaining to you each and every concept. You just need to tell me that what rate is applicable. Okay. So we are talking about the retirement of the bill. Let me just give you the scenario that what is the retirement of bill. Let's say person A is the importer and person B is the exporter. So who draws the bill? Exporter draws the bill on person A. A accepted the bill and bill is returned back to person B, right? So bill of exchange was drawn. It was accepted by person B and returned back, right? That was the case. And let's say due date was after 3 months. Let's just assume that the due date which was mentioned on the bill of exchange was 3 months. Okay. But after 2 months, let's say, or the period before the due date of the bill of exchange, A decided so as to pay off the balances. So A connected with their bank. Let's say XYZ is a A's country bank. Okay. So A decided so as to connect with the bank, XYZ bank, and further so as to pay the amount in advance. So whatever the amount which was to be due after 3 months, A decided so as to pay this amount in advance. This whole process is said to be the retirement of the bill. This is said to be the retirement of bill. So XYZ bank will be connected with the counterpart in the B's country. Let's say it's a PQR bank, right? And further the amount shall be paid to the person B here. The amount shall be paid to the person B here. Okay. So this is a transaction that is going to be there. But if we look at the deep inside the transaction, person A is the importer who is not having the foreign currency and but having the INR. He is having the INR and he wants to buy the foreign currency. And in this scenario, he is to buy 50,000 USD. He is to buy 50,000 USD. That is to be done, right? And whenever the customer wants to buy or the customer is basically there in the transaction, then the merchant rate would be applicable, that we know. So in this scenario also, what rate would be applicable? It is a merchant rate. It is a merchant rate applicability. Okay. So what quote will be given? So customer wants to buy, right? So what rate will be given? It is a selling quote which will be given by the bank. Selling quote. So as for the transaction, so as for selling the USDs upfront for the payment purposes, the selling quote will be applicable. And this would be the same day transaction or some other day transaction. This will be the same day transaction. Why? Because XYZ Bank simply would be debiting the Nostro account and will be crediting it to the customer's account. That's it, right? So it's a TT rate which will be applicable for the selling of the USDs. So I can be writing over here that the first part it's related to selling the foreign currency or selling the Forex. That's the first leg. In that scenario, the TT rate would be applicable and cost given is the selling cost. So it's a selling TT selling price or TT selling rate which will be applicable. What was the formula related to it? Very easy. Spot rate. And in case of selling, the exchange margin is to be added up or subtracted. The exchange margin is to be added up. Exchange margin would be added up. Now, even after the USDs are now available on behalf of the customer, definitely it's going to take time so as to adjust the account of the person B. It's going to take time. So there is a lag between it. So after that, the exchange margin related to the bills selling rate would be applicable, right? So the second case, it's related to settling the account with the exporter. Settling the account with exporter. That's the second leg that is to be done after purchasing, after selling the foreign currency to the customer, right? And that's a time lag. So bills rate would be applicable here. And bills, because it was a selling cost, so it's a bill selling rate which will be applicable there, right? So in this scenario, if we combine these two, what will be the formula? The formula would be the spot rate, further the TT selling rate exchange margin, right? Because it was a TT selling exchange margin. Further, the bills selling exchange margin, because after that the account is to be settled. So it is bills selling exchange margin. So this is how we are going to solve this question. So this will be the complete formula related to it, right? And this is what rate? This is a bills selling rate which will be applicable. It is the bills selling rate which will be applicable. Clear with it? Have you understood this point so far? Do confirm. Okay, so two kind of transactions was there, because when the importer will be purchasing the foreign currency, that will be an instantaneous transaction. That will be the same day transaction. And in that scenario, there will be no lag. So that will be the TT transaction. And after that, when it is to be settled, it's going to take a while. So in that scenario, the bills rate would be applicable. Now, what rate would be applicable in this scenario? The customer wanted to buy, and the customer will be able to buy at a price at which the bank is ready to sell. So it will be the selling cost. So it will be the exchange margin as per the selling rate. Okay. So the related formula for this case is this one. That is bills selling rate is equal to spot rate plus TT selling exchange margin plus bills selling exchange margin. So if you have to solve this question, answer is very much easier. Spot rate is given to be 72.30, 72.40. The selling rate is to be considered. So it is 72.40, 72.40, right? And for the, first of all, the TT selling rate, exchange margin 0.145%. That is to be calculated. Keep in mind, first of all, you have to solve this bracket plus the other one. That is 0.20%. That's related to the bills selling exchange margin, right? So it is 72.4 plus 0.15% plus 0.2%. That is 72.6536. 72.6536. This will be the answer. This will be the answer. Okay. Now after that, let's solve the other question. Very important one again. All these questions are very much important. Let's have a look at it. It says 1 USD is equal to this one. 2-month forward is given. And if person A want to remit the 10,000 after 2 months, what will be the cost to person A? We want to calculate the cost to person A. So A want to remit money. A want to remit money. You just tell me first of all that what rate would be applicable. That what rate would be applicable. It will be the bills rate or it will be the TT rate, which will be applicable. Now A want to remit, but the person wants to remit after what time period? Not today. It's after 2 months period. So definitely bills rate would be applicable in a sense, right? And A want to remit means A want to buy the USDs. Now A will be able to buy the USDs at the price. The bank will be quoting the selling price. So the quote will be given, that the selling quote will be given. So it is a selling quote which will be given by the bank here. Okay. So it's a bill selling rate, we can say it will be applicable. It's a bill selling rate which will be applicable. And the spot rate given over here is, the spot rate is given to be 1 USD is equal to 76.10 slash 30. This is the buying rate. This is the selling rate. Okay. This is buying rate. This is selling rate. And also 2 month forward points are given. These are given to be 45 slash 35. We have to consider which one, the buying rate or the selling rate. Do answer. Do answer. You should be participating. You should be answering the points here so that you can learn much more. So it is the selling cost which was to be given now. So it is the 76.30. That's the selling rate. Selling rate is to be considered. I told you that why selling rate is considered, because selling cost is to be given. So selling rate is 76.30. And if we look at the forward points after 2 months, there is a trend from left to right of decreasing, or simply we can say the selling forward points are lesser than the buying forward points, means the currency is available at discount after a period of 2 months. The currency is available at discount. And when we say the currency is available at discount, the forward points are to be subtracted. Which forward points? The selling forward points. So 0.35, these are the selling forward points. And these selling forward points are to be subtracted. So it is 75.95 if I'm not wrong. 75.95. So what will be the cost to person A? It is 75.95 multiplied by 10,000. So it is 759500, right? So that will be the cost to the person A. Okay. Now let's solve one more question. Question is again related to the foreign exchange arithmetics. So Forex rate in Mumbai is USD 1 is equal to 68.1030. So we are provided with the 1 USD price equal to 68.10 slash 30 INR. That is given to you. In UK, 1 euro, 1 euro we are talking about is given to be 1.05 slash 1.10 USD. This is given to you. An exporter wants to discount the export bill of euro 10,000. Exporter wants to discount. I told you about the discounting or purchasing of the bill. When it is about the discounting or purchasing of the bill from the customer point of view, it means you are owner of this foreign currency and you want to sell this foreign currency, right? So if a bill is available with the customer A amounting 10,000 euro, the customer is going to the bank XYZ. Customer want to basically sell these euros. Customer want to sell, and bank will be giving the quote. The what quote will be given? Because the merchant rate is applicable. When customer is dealing, merchant rate is applicable. So customer will be able to sell at a price at which the bank is ready to buy. So it's a buying quote which will be given by the bank. Buying quote given by the bank, right? So buying quote is to be given. Clear with it? And now you are having the euros with you. You are having the euros with you. There is no direct combination related to the euro to INR. The combination is related euro to USD and USD to INR, which is available. Now, first of all, you will be selling the euro and getting the USD, and then you'll be selling the USD and will be getting the INR. Now, accordingly, we will be calculating the answers. Here the buying rate is given, here the selling rate is given. Buying rate is given, selling rate is given. The first rate would be related to that you will be selling the euros, right? You'll be selling the euros and you'll be selling the euros at a buying price. So what rate would be applicable from this statement? It is 1 euro is equal to 1.05 USD, right? It is 1 euro is equal to 1.05 USD. Now, once you are having the USDs with you, you'll be selling the USDs from the second equation. So the rate is to be picked up is basically you are to sell and you will be able to sell at a price at which the bank is ready to buy. So again, the buying quote would be applicable. So it is 68.10 INR. That's it. Now, can you be equating these two? Not so far. We have to make this equation in a manner that we can be equating these two. So it will be equal to 1 divided by 1.05 and further euro and is equal to 1 USD. Now you can be equating these two sides. So from these two, we can be saying that it will be 68.10 INR is equal to 1 divided by 1.05 euro. And it implies that 68.10 multiplied by 1.05 is equal to euro divided by INR. And this was the rate that you wanted to calculate. So it is quite simple. 68.1 multiplied by 1.05, that is 71.505. This is the euro to INR quote that you have calculated. And how much amount will be given to the exporter? How much amount? Just multiply it with 10,000. So it is 715050. This amount will be given to the exporter. This amount will be given to the exporter here. So make sure to like this video if you have understood the concepts, and just WhatsApp me writing CAIIB to the number 83609 and I'll be sharing all the details with you. You should be downloading our application because you'll be getting the access to the case study videos, chapter-wise previous year questions, mock test, mega test, PDF notes, everything is available. And after the live sessions, the classes are just available to the premium members. So make sure to just WhatsApp right now and download the application. And if you are iOS user, it may be asking you so as to enter the ORG code, which is GEGKT. This is the ORG code, organization code, right, for the iOS user. So download the application and start your preparations. Happy learning.